you've done a lot of these for, I guess, a while. Uh, tell me how did you get involved in uh, with the all-in-one?
Sure. So the history is the product was introduced way back in 2005. And um, I had been doing some research or something, and I came across the product. And back at that time, I was actually doing a radio show on Saturday mornings. And Chris George was and still is the president of the company that offers it. And I called him and I said, "How would you like to be on my radio show? I'd like to talk about this product." And he said, "Sure, what time is it?" And so I told him we did the conversion, and he had to get up, poor guy, like about 5 o'clock in the morning, California time, in order to be on my Saturday morning radio show. And I was just really enthused about the potential. And so I started offering it at that stage. 2008 came along and kind of put a crimp in a lot of mortgage terms. And so it was temporarily withdrawn from the market. And then when they reintroduced it, back at that time, it was called the Accelerator. And when they reintroduced it, renamed it to the All-in-One Loan. And essentially, the exact same product as was out there before. So it's got quite a history. It's been around a long time, especially it's been in Australia for years and years and years. So we're late adapters here in the United States.
And how many clients have you helped get an all-in-one?
Oh, geez, over that whole time frame, dozens. I don't track the loan program specifically, but
Right.
I've had a lot of people that I've worked with on it, and they are almost exclusively just really enthused about it. I can tell you, the mortgage requires a bit of discipline because you have access to your equity. And I had one customer that we had to move back out of the product. Unfortunately, when we were doing all the due diligence and qualifying, there wasn't an issue yet, but the wife got hooked on gambling in between and had an ATM card, which essentially had access to the mortgage. And so he called me and said, the numbers projected real well, but my balance just isn't going down. So I said, bring in all your bank statements. We're going to look at your cash flows and see what's going on. And casino was skewing the numbers. And so we just moved him out into a regular mortgage where she couldn't access the line of credit. And that's the only one that I've had that was not successful.
So that's pretty cool. Like if it's not working, you can switch out. You're not married
Correct.
to.
Yep, you are not stuck in the mortgage. It is just like any other loan. A lot of mortgages, if interest rates go down, people will refinance. You can refinance out of this for any reason you choose.
Yeah. So what are, I've got so many questions. What are the requirements of someone where this, like, for the loan to make sense? Like what are the, like, my personal requirements if I wanted
Sure.
it?
So it requires a minimum FICO score of 700. Again, they want that financial discipline. The equity in the home, if you're doing a refinance, 20% equity. On a purchase, we can do as low as 10% down. And the product has to be a conforming product. So can't do single wide mobile homes, and you can't do 5 to 8 investment properties, that type of thing. But
Right.
other than that, it's pretty much just based on us running a calculation of how the cash flows will work for Charlie. And at that point, we sit down and show that comparison of this is a conventional mortgage, this is the all-in-one, and people make a decision if they like to move forward.
Can you have more than one at a time?
You can have up to 2. However, generally, it probably doesn't make good sense, because I think now is a good time to talk about how the mortgage works and why I'm more in favor of people having just one.
Yeah.
So, and I'm going to start by talking a little bit about a traditional mortgage, and then we're going to contrast how the all-in-one works. So on a traditional mortgage, your payment, and a lot of people don't realize this, but is applied interest first and then principal. And on a 30-year term, the amortization is that a much heavier chunk of that first payment is interest than principal. And if you think about it, when you make that principal payment and you're on a fixed rate mortgage, you've gained equity, but the equity is locked in there because it's applied down to your mortgage, and you can't call a mortgage company and say, hey, Charlie, I sent you $250 that went towards principal and I could really use that back. Can you send it back to me? They're not going to cooperate with that. Okay. So
That's not their business model.
no, no, it is not their business model. And so if you remember, traditional interest first, and then the principal is reduced and the money is locked in there. On an all-in-one, what you have is a checking account that's tied to the mortgage. And as soon as money is deposited into the checking account, at the end of the day, it sweeps over into the mortgage and immediately reduces the principal balance on the mortgage. It stays lower until you need the money. And then as you write checks, adds back onto the principal again. So as long as you have cash flow that is better each month than the balance that's owed on the mortgage, it will work on reducing itself. And, if you think of, people manage their money, your mortgage payment is once a month, but that's not the way people's money comes and goes. So, your cell phone payment is once a month, maybe your vehicle is twice a month, and you might grocery shop 4 times a month. So as people—
For me, with my 4 kids, we grocery shop twice a day.
Convenience store and regular store. So the cool thing is, with the all-in-one mortgage, you get an ATM card that you can get at it, wherever you're at.
Yeah.
So again, the difference here is the money is really applied first to principal, and then once a month they're going to calculate the interest, and you're going to get billed for that interest. It basically pulls back out of the mortgage again. So goes back, when I say pulls back, it adds back onto the balance whatever the interest was for that month. But the interest is calculated every day based on what your balance is, based on how much money was in the account that particular day, applied down on the mortgage. And then at the end of the month, they add up all of those days. And where your normal monthly payment is due on the first of the month, this interest isn't due until the 23rd of the following month. So you get extra time basically for your principal to have sat there and reduced the mortgage.
That's really cool.
So then people start to get creative. I found a credit card now that I don't have to pay the balance until 45 days after I use the money. So okay, now I'm using their money for 45 days instead of 30, and that money stays in the mortgage, holding the balance down until I have to pay the credit card bill. So it's just something that is so different in the way it works that a lot of people have a hard time wrapping their mind around it. And usually I'll have 2 or 3 or 4 conversations where they'll go, okay, now what about this? And so we just go through and explain that as many times as it takes for them to really grasp it and decide that it's a good tool for them or not.
So yeah, with that, there's a lot of really cool ways. My mind is slowly kind of, the Rubik's Cube is answering about that credit card. You basically have the credit card, you put towards, you've got it in to pay down your principal until the credit card's due.
Mm-hmm.
And then you just take it out of here, pay it off, and then you can do it again. And
Correct.
So your principal is down however much that credit card is for 90% of the time then, right?
Yes. And another thing, a statistic that I saw that's pretty interesting is that most people move way more money through their checking account than they really realize they do. A lot of times in 5 years, they'll move as much money through their checking account as the cost of their mortgages. But, usually there's a separation between the mortgage and your account. So the times that you have excess money sitting in your account, you might be earning 0.5% interest or 0.25% interest on your checking account. Your mortgage is accruing interest at the full rate. So just the fact of tying those two together and moving that money over so that it's holding the principal balance down on a day-to-day basis is what makes the mortgage perform so well.
That makes sense. Yeah. And so why would you only want to do this for one house or one property instead of 2?
So if you think about, you're using that mortgage to hold the principal balance down. So the more money you can throw at it, the faster it's going to hold the mortgage down and pay off. So if you're splitting that between 2 properties, it's going to be effective on both, but usually the most effect is on the first one. Now, you can do this on an investment property. And so I've got a lot of investors that are looking at it. One of the cool things is, most investment properties, you have 25% down or even 30 on the all-in-one. It only requires 20% down on an investment property. And the other thing is where interest rates are much higher normally right now on a second home or investment property, the only extra charge on the all-in-one is 1/4 of a discount point initially at closing for your investment properties.
That's
So
it.
that's it. So sometimes I'm talking to people and they have a really good interest rate on their primary mortgage, but they want to buy an investment property. If they meet the criteria, I'm talking to them about an all-in-one because it just makes so much sense to have that, A, smaller down payment to get you in, B, the fact that it's working to pay itself off, because then the next step is usually if somebody gets an investment property, they're generally looking down the road, and the all-in-one is working to put equity in there to help you with the down payment for the next one.
Right. And I guess it would work, I've got some clients, they want to keep their, got one client that, she didn't want to sell her house right now because the price has gone down, but she wanted to buy a new house. So we, and she had a great rate for her current one. So she's renting that one out. Could someone all right, they want to keep their current rate, so they rent that house out, but they buy a second home then with the all-in-one, and that way it's
Sure. That's
all
primary residence wouldn't be subject to the extra 1/4 of a discount point. So yes, that would work fine.
And I'm guessing that way, if cash is tight, all you have to pay is the minimum, though that's not your goal. So explain that to me. I guess the cash flow itself kind of solves that. Is that right?
It does, because as you put money in, it's reducing the balance. So as long as you've put more money in than what the interest billing is going to be, when the interest billing adds up, your principal has still reduced, and generally more than a traditionally amortizing mortgage is going to.
Because we've got money sitting in our account. I mean, all the time, that's just not being used. But this way, that money in the account every day is lowering the payment, right?
Lowering the principal balance so
Which
that,
is better.
yeah. And then now remember, when they're going to bill you for the interest, that's all you're getting billed for is the interest. So there's not an escrow account. There's not a principal payment that's applied because it's doing that all by itself. So all they're going to tag you for is the interest, and it's just going to be pulled back out of the equity in the property when it's due. And then as next deposit in reduces the balance again. So you're always freeing up that additional money.
So my mind just blown. Like, you're paying down the principal by just using your bank account, and you just pay the interest only each month, but just your money in the account is pushing the print, like you're just living and the principal's going down and you
Correct.
pay just only payment.
Correct. So there's not an escrow account, but if you think about it, when your escrow account, what you're doing, you're putting money in an account that they're going to give you back to pay your taxes when they're due, or the company pays them for you. Here,
Right.
your escrow account is essentially sitting in the equity in the house, holding the mortgage balance down until the time is due for you to write the check to the tax company. Another advantage, self-employed people, your quarterly estimates, that money is sitting in your account until the quarterly estimate is due. And
Right.
another good example is people that have accounts where they buy and sell, like retail. I had a store owner that had a little store, and she would put the cost of goods onto her mortgage. And then as her profits from the sales came in, it would reduce it down again. So they recently sold the store to retire and called me up and they said, hey, do I have to do anything with my mortgage? I love it. I want to keep it, but we've got enough money that we can reduce the balance to 0. And the way it works on the line, Charlie, is the first 10 years, the line is full, whatever you start with. And then after that, it reduces to a 0 point just by the equity line being reduced each month. The accessible equity line reduces 1/240th each month. So I told him, no, you're like 12 years into this loan. You'll have a zero balance, but you still have, look at your statement, that much is available to you every month. The only charge that you get is once a year, then a line charge, which is $50 or $60, depending on the state you're in.
Gotcha. And if they wanted, could they quote unquote refinance to start the cycle over?
You can, yes. If you wanted your line moved back up for some reason, you could do that. The reason he wanted to make sure it was open is he's been talking to the guy about the lot next door, and he said, if it becomes available, I can just write a check and we can close.
Right, right. And then he can refinance that traditionally if he wants or whatnot.
Right. Or the accelerator, I mean the all-in-one will keep working on paying itself off to get rid of that lot loan.
That's right. Yeah, that's even better. You just live and it pays down.
Now, a couple of other points that I'd like to make along it. We talked earlier about on a traditional mortgage, your equity is locked in. You can't really access it. You can get a HELOC, but a couple of strong advantages on this versus a HELOC. Number one, in the event that the equity, the bank perceives that your equity has gone down in the property because market values are reduced a little bit. On a HELOC, the bank has the language in the HELOC that they can restrict your balance on the HELOC. And I had that happen to me on a property on my primary residence back during the 08 timeframe. They just reached out and said, hey, we were lopping 20,000 off the availability on your HELOC. Fortunately, I didn't need it at that stage, but that's kind of an issue.
Yeah,
Another thing,
I've got a HELOC, and that is one of my fears. Like, what happens if I really need it?
right? Another thing that I like to talk to people about is having a HELOC available so that if something unforeseen happens, you've got access to that money. But a lot of people say, well, I'll just apply for it if that occurs. Well, Charlie, if you lose your job and then you go into the bank and say, hey, I've got really good equity in here, but I like to open a HELOC now because I don't have a job. As you said earlier, that's not their line of business. So,
Right.
so the all-in-one, you have that line. You've had it from the beginning. They don't take it away if anything happens after you're in the property, and they can't restrict the size of the line based on current market conditions of the real estate values in your area.
Really?
Right. That is not part of the mortgage.
Now, are the interest rates really high?
It's an adjustable rate mortgage. And so right now the rate is probably, because short-term rates are up right now with the Fed Reserve putting the brakes on, we're probably a little bit above where you could get a fixed rate mortgage, but a guy I know once said that, interest rates are bragging rights at a party. What I want to know is what's the effect on, on my lifestyle and where am I going to be at the end of the term? And
Right.
so, yeah, even though the rate might be higher, generally it's going to outperform.
And your interest, I mean, your minimum pay, I mean, your interest only payment is going to be less than an amortized, right?
Yes, in all likelihood, it's going to be a smaller payment.
Yeah. How much extra cash flow do you need to be able to really where this makes sense for you?
So that's not a question that I can answer because it's scenario to scenario. What we do is you have to be approved to, as a loan originator, you have to go to the training to be able to offer it. And so the input questions that we ask are, how often does your income come in? How much is it per time? Do you have like one-time installments of cash out there that are going to come in? An example of that might be where you talked about somebody selling their house. And so they may have a scenario where I've got enough down payment to be able to buy the house with an all-in-one mortgage, but when I close 90 days from now, I'm going to get a cash infusion of $45,000. We can show you in the program, here we are, we're 8 months in now or whatever from the time frame. If you do a 45,000 infusion of cash, this is how it's going to affect your long-term mortgage. I just did one for a lady that, she has been through some tough times, in the business cycles, and she has a significant amount of cash sitting in her account. And she said, I like to know that I have access to that. And I explained, well, you do, but what if we took your purchase and we left all your cash in that account and you get comfortable with it for a year, and then you say, okay, instead of having, 6 figures in an account, I only need to have 15 or 20,000. We'll apply all of that money a year out and see what it does. And her payoff went down to like 8 years. Yeah, because all that money was working for her instead of earning her. Well, this was paying pretty good for a savings account. She was getting about 1.25%. So
Yeah. What a great deal for entrepreneur or me. I've got a real estate practice. I get big checks and then I go a while without a big check and then I'll get a bunch of big checks.
Mhm.
And I get a big check now, I just put it in the bank and I slowly, pay
Right.
it this way. I get big checks one month. My principal goes down for that time, right?
Exactly.
What are the cons to this? Like it
Okay.
seems amazing.
So the cons, it is an adjustable rate mortgage. So you don't know, ahead of time what your actual interest rate is going to be. When we do the simulator, I'll a lot of times run it a couple times saying, okay, and what I like to run is, here's the historical average rate, and it goes back 20 years. And if we run it with the historical average rate, chances are rate's going to be higher at some point, lower at some point, but that's a pretty good fix. Then I can also say, okay, we're at the highest rate that we've been for quite some time now. Let's just show you what it would do if it just stayed here. And then we can also run a worst case. And, okay, if it goes to the maximum that it can and stays there over time, what's that going to look like? I think we're all pretty confident it won't go to the max rate and stay there the whole length of time. So usually, people will look at one of the scenarios in between. The second drawback is you do have to have some restraint. You've got that access to your line. And so I had that one that I explained to you that, that mortgage did not work for them.
So if
And
my
then,
wife's betting on the horses, might not be a good idea.
yeah, unless she's really good at it. So, so, those are the two, really biggest drawbacks. There is, in order to get the loan boarded and set up and ready, there's a little bit held back at the initial closing because until the loan gets boarded on the system and the checking flows get coming through, they would just want to make sure that you don't overdraw the line. So they hold back like an extra 2% of the line amount. So it's not really a drawback, but it's just one of the things that happens. And, a lot of steps happen to make sure it's a good fit. So after I would get done originating it and it gets through underwriting, they actually have a team that calls and say, okay, Charlie, you're approved. This is how the line is going to work. Do you understand that this? Do you understand that this is adjustable? Do you understand that you don't have full access to the line until the loan is boarded? So instead of going through and making sure that you have full understanding of the way it's going to work.
So they really take care of their clients.
Yeah, it's not something that is underwritten like with eyes closed. We're looking to make sure that everything is a good fit on the loan.
Yeah. How long does it usually take for someone to be approved? Is it a much longer time frame than normal?
No, it really isn't. I had one that I did an application a little over a week ago. We have the credit approval in place. We're just waiting on the appraisal to come through right now. So, a 30 to 45 day window is completely acceptable or expected for this mortgage to close.
Yeah. Well, this has been fascinating. Is there any other questions I should ask? Because right now I'm just like, man, this is amazing. I want to tell all my friends that have extra cash flow. I've got one friend, he saves up for a car. And so he's got his $60,000 in his car account when he's ready. Like, take this, put this towards your principal. Like, what blows my mind, and I'm just shocked. Just living pays down your principal. Like, I've already got the flows coming through, and then your required payment just keeps getting smaller and smaller, and just living, it goes down like
Right.
that. It seems unbelievable. Pretty
And
cool.
Charlie, it's not voodoo, it's just math. If you have dollars applied to reduce your balance, you're going to pay less interest. And so you're right. You're thinking of the exact best customers for this product. Somebody that has, strong cash flow. That's the biggest thing. And as I said, a lot of people start to get creative with how can I maximize the time that sits in the account. So maybe you pay your taxes twice a year and you have the option of only paying once. Now that money sits in that account longer. And maybe right now you pay your homeowners or your insurance on your vehicles and stuff every month. Might be slightly more to pay it once a year, but then you're sitting on the insurance company's money in your account for that time frame. So people tend to get more creative with ways to keep the money in the account as long as possible. And some of them look at it and think, well, that new car would be nice, but right now I got 60 grand reduced off my mortgage.
Right. Yeah. So what's what is the end result of this for most people? Do they end up paying their mortgage down faster? I mean, I know everyone's different. Do they just have more freedom? What have you found from your clients that benefited from this?
Most people do wind up having, first of all, a lot of times they'll get the loan almost paid off and then they'll find a vacation home or something. So they wind up using the credit throughout the term. But if you look at it, not just on this mortgage, but on net worth, significantly better because they've had that much equity built up and they want to buy that vacation home. Hey, we can almost pay cash for it because we've got the money in here to be able to do it.
Right.
I have a really close friend. I've done business with her for years. She's a real estate agent, and I did this mortgage for her. And she's going to sell her house soon, and she'll have enough to pay off her house and almost all of her second home because she built equity in the property.
Wow.
And the other thing is she's had peace of mind during that time frame because we're in northern Wisconsin, and things don't sell real fast here when there's 2 feet of snow on the ground. So that early part of the year, she doesn't have to worry about her cash flow being so high because, worst case, if she gets a month where she gets skunked, she got access to her equity line where she can borrow from it a little bit until spring comes and the cash flow starts up again.
Right. Yeah. I mean, right now, every year, me and my mentor years ago, we talked about this. Starting in November, I start socking away money. And, so I've got money saved up November, December, so that, sometimes I'll prepay my electric bill just to, get ahead because that's the real estate market. Like, I'm not gonna be shocked by it anymore. Imagine like right now, that money that I save up does nothing to my principal.
Right.
So that money saved up would actually like lower my payment, like reduce my principal. And plus, if we get to the end of March and we got an extra freeze and I need for a few more weeks, I've got cash there to pull. And then if I want to buy a second home, instead of having, I might not even have to get a second mortgage, which would have its closing cost. I might be able to just cut a check.
Correct.
Which, I'll be able to get the house cheaper by paying cash, and you save the closing cost. And
instead of sending your utility company money ahead of time for them to sit on, it sits in your account holding your balance down.
Right. How cool is that? And you just live and it's being paid down. That is just brilliant.
Yes. So people that, let's talk about debt to income ratios. Basically, you have to have 10% reserves available someplace. in order to qualify for the mortgage. If you have 10% reserves, then your debt to income ratio can be 41%. And if you have 15% reserves, then your debt to income ratio can be 43%. And that's calculated at the fully indexed rate, so index plus margin, amortized over 30 years. So they are looking to make sure that you can make that payment to get you down to that zero balance when the end of the term comes, because your line is going to be reducing. But most people don't have to worry about that. They're not bumping up against that ceiling as the mortgage limit is reducing.
Yeah. I guess there's a maximum home price that you could use this with.
Well, you have to stay essentially, well, you don't have to stay below the jumbo limits. I think it's $1 million. Gotta remember, Charlie, I live in northern Wisconsin, so I'm not bumping up against that real often.
Yeah.
I'll look it up and I'll get back to you on that one.
Gotcha. Well, this is fascinating. Is there anything else you want to share about this? Or like, how can someone reach out to you if this piqued their interest?
Sure. So my phone number, my direct line is 920-351-4663. And my website is jerry@jerrykalnin, CALNIN.com.
That's awesome. Well, thank you for this. This has been mind blowing. I've been in real estate for a while, and I've heard this term, and some people say, oh, you shouldn't do it, it's risk. You hear things from people that don't know, and then my buddy had people paying $6,000 kind of for what you just gave. And I'm really, really thankful for this to be able to share with my friends, and I'm gonna look into it for myself.
All right, that sounds good. Jerry@jerrykalnin.com. There's an application link right in there.
Perfect. I like it.
All righty, Charlie. It's been great talking to you, and hope to see you soon.
All right, bye.
Bye.